Another consideration for the sales is sales return. If the merchandise is returned, the customer will get a refund or store credit can be applied to other purchase. The seller may provide special price reduction called allowance. This is similar to the price matching. The price matching actually is to encourage the customer to keep the product instead of returning it. The methods we use to account for the sales return and allowance is we accrue sales return and allowance at the time of sales. Otherwise, recognizing sales return when they occurred could result in overstated income in the period of sales and unstated income in the return period. The reason is the accounting financial statements are prepared periodically. So the sales may happen here in this accounting period 1, while return or allowance maybe occurred in the period 2. If we do not account for the potential sales return or allowance in period 1, the sales in period 1 will be overstated or the income will be overstated. So for example, in December 2024, the sales was $10,000, cost was $6,000. The difference will be the gross profit earned by this company in 2024. If in 2025, all the merchandise was returned, but keep in mind, at the end of December 2024, this company will prepare its financial statements. At that moment, we cannot account for this return in the next year. In other words, we have overstated 4,000 gross profit in the financial statement of 2024. This overstatement will result in understatement of 2025 when this sales return occurred. To solve this problem, we use accrue sales return and allowance methods. So here is how we account for the sales return. During 2024, the company sells merchandise $2 million cash. So we debit cash, credit sales revenue. And also the cost of this merchandise was $1.2 million. So we debit cost of goods sold at expense and credit inventory. Based on the experience, 10% of all sales will be returned, which equals to $200,000 sales will be returned. Even in 2024, there is no sales return actually occurred. So because the return may happen later, we know the merchandisers usually allowed the customer to return their goods for a certain period. Since return is very common, so we should account for the sales return in the current year when the sales occurred. Based on the industry experience, 10% sales will be returned by the customer. In this case, it equals to $200,000. Some return may be returned in 2024. If we just account for the amount of returns, for example, 130,000 sales was returned. Based on this estimation, there are still expected $70,000 sales will be returned in the following year. Okay, so first we should account for the actual return, $130,000 in 2024. So we debit sales return and credit cash. So sales return, see, this is debit. So this will reduce the sales revenue. Actually, originally, we record $2 million sales. After this journal entry, it will less this amount, $130,000. So the difference will be the net sales. We know revenue has credit balance. Sales return is debit balance. Sales return here is a contra account of revenue. So when the sales returned, company will receive inventory back, and we will reverse this journal entry by record this returned goods and also write down the cost of goods sold with credit cost of sales. This $70,000 was just expected based on the industry experience. Even this expected return has not happened. But for financial accounting, we should also account for it. Just like what I just mentioned in price slides, to avoid overstate of sales. So we also debit sales return and credit return liabilities. Since it is not an actual return, we do not credit cash. We just credit a potential refund or cash outflow. We use a liability. We also debit inventory. This is from estimated return and the credits cost of goods sold. This, the net sale will reduce by both actual return and the expected return. So the net sales will be $1,800,000. Yeah, this actually reduces the net sales, so to avoid overstate sales revenue. And assume in the following year, 2025, this sales return actually occurred. So then we will debit refund liability and credit cash. And then we will debit inventory and credit inventory estimate. So here, inventory and inventory estimate return are two different accounts. Okay, so here we do not debit inventory. Instead, we debit inventory estimate return, because the company just estimated the return. There is no actual $42,000 inventory was returned to the company. Remember that in this slide, the $70,000 return was expected. If the actual return was $60,000 instead of the expected, so we should incorporate the difference into accounting determinations in the next periods. So following this journal entry, we will debit refund liability and credit sales return. Liability will reduce to $60,000. Similarly, we should also debit cost of goods sold and credit inventory estimate. The amount is 60% of the $10,000. After this journal entry, the refund liability reduced from $70,000 to $60,000. Sales estimate, inventory estimate return, it reduced from 42 to $36,000. We are given the refund liability 0, so the account refund liabilities has 0 balance. Sales was $1 million during 2024. The cost was $600,000, which accounts for the 60% of sales. 1% will be returned. So 1% of the total sales revenue is $10,000. And $8,000 was returned during 2024. That also indicates there are another $2,000 expected return in the next year. So to account for this estimated return, the $2,000 expected return will occur in 2025. To account for this, we debit sales return and credit refund liabilities. Since the beginning balance was 0, after this journal entry, it has $2,000 credit. The question asks us inventory estimate return based on the same information. So we debit sales return, credits refund liability $2,000, and also we will debit inventory estimate and credit cost of sales, which is 60% of this amount. So the answer is $1,200.